Robinhood stock has been one of the hottest names in 2025, riding a powerful rally that's taken it into the $100 billion market cap club and put it front and center in conversations about fintech and crypto. But as we wrap up the week, one question looms over Robinhood and really the whole market. What happens if the Federal Reserve follows through with interest rate cuts? On Friday, Hood finished at $109.32, up nearly 3% for the session but still down a little over 3% for the week. That bounce came on the heels of fresh signals from the Fed suggesting that rate cuts could be coming sooner rather than later. It's a development that has traders buzzing, and for Robinhood, it raises an important debate. Would lower rates hurt the company's business model, or could they actually unlock the next leg of growth? Let's start by breaking down the bear case. Robinhood has made a lot of money over the past 2 years from something called net interest revenue. This is the income it earns on uninvested cash balances in customer accounts, margin loans, and securities lending. When interest rates are high, Robinhood gets a bigger return on that idle cash. In its most recent quarter, net interest revenue was one of the biggest contributors to overall growth. So naturally, if the Fed cuts rates, that revenue stream could shrink. Some skeptics worry that rate cuts will hit Robinhood right where it hurts. The argument goes like this: interest income has been a huge tailwind, and if that tailwind turns into a headwind, earnings could stall. Combine that with increased competition in the brokerage space, and suddenly the stock might look overvalued. But there's another side to the story, and this is where the bull case comes in. Lower interest rates don't just reduce net interest margins. They also stimulate risk-taking. When money is cheaper to borrow, people are more likely to trade, to invest, and to move money around the markets. For a company like Robinhood, which thrives on active users and transaction-based revenue, this can be a major positive. Think about the last major rate-cutting cycle. Lower rates fueled risk appetite in everything from stocks to crypto. Volumes surged, retail participation climbed, and platforms like Robinhood saw huge spikes in engagement. If we're heading into a similar environment, Robinhood could more than offset weaker interest income with stronger trading activity. Crypto, in particular, is sensitive to interest rates. A more accommodative Fed tends to push investors toward riskier assets, and Bitcoin, Ethereum, and other tokens often benefit. For Robinhood, which just reported crypto trading revenue nearly doubling year over year, this could be a major catalyst. If crypto rallies in a lower-rate world, Robinhood's volumes, and its revenues, could explode higher. It's also worth noting that Robinhood is no longer just a US stock and options platform. The company has been expanding globally, integrating Bitstamp, and rolling out tokenized assets in Europe. These initiatives diversify its revenue streams and reduce dependence on net interest margins. In other words, even if interest income dips, Robinhood has other engines ready to fire. CEO Vlad Tenev has been making this point directly. He's gone on record saying that Robinhood can still grow even in a lower interest rate environment because the company is innovating and diversifying. Tokenized stocks, crypto staking, and futures products are all high-growth areas that don't rely on Fed policy to succeed. By emphasizing these forward-looking initiatives, management is telling investors not to get hung up on just one line item in the earnings report. Now, let's consider the market psychology angle. For much of the past year, Robinhood has traded as a hybrid story, part fintech, part crypto play, part meme stock revival. But increasingly, the narrative is shifting toward fundamentals. Investors are looking at user growth, assets under custody, and transaction-based revenue. If rate cuts help boost those fundamentals by encouraging trading, then the stock could find a more durable base of support, even if interest income slips. At the same time, lower rates tend to lift valuations across the market. Discount rates go down, and future earnings are worth more in present terms. Growth stocks, especially in tech and fintech, tend to benefit disproportionately. Robinhood fits that mold. A Fed pivot could give Hood not only stronger user activity but also a valuation bump from the broader market re-rating. That doesn't mean it's all smooth sailing. Investors should still be mindful of the risks. If crypto fails to rally, if regulatory pressure increases, or if the broader market loses confidence in fintech, Robinhood could face headwinds. And while rate cuts may increase trading, they also compress margins for the entire brokerage sector, so competition could heat up. But the key is balance. For Robinhood, the potential positives of lower rates, higher trading activity, stronger crypto markets, and valuation support look poised to outweigh the negatives of reduced net interest revenue. So what does this mean for the week ahead? Investors should be watching a few key things. First, crypto price action. If Bitcoin and Ethereum build momentum, expect Robinhood to trade in sympathy. Second, any new commentary from Fed officials. The Jackson Hole Symposium is always a big event, and any clarification on the timing of cuts could ripple through fintech stocks. Third, analyst commentary. We've already seen firms like Piper Sandler and JMP raise their price targets in recent weeks. If more analysts come out bullish, that could reinforce the upside case. Finally, watch for updates on Robinhood strategic initiatives. Any news on Bitstamp integration, tokenization adoption, or S&P 500 index speculation could layer on top of the macro story and give traders more reasons to buy. To sum it up, Robinhood had a bumpy week but ended on a high note, thanks in part to optimism around Fed policy. Looking forward, the question isn't just whether rate cuts hurt or help Robinhood. It's about whether Robinhood's evolving business model is positioned to thrive in a world where rates are lower and risk appetite is higher. The evidence suggests it is. The company has moved beyond being just a meme stock trading app. It's now a diversified fintech and crypto platform with global ambitions. Rate cuts may trim one revenue line, but they could unleash far bigger gains elsewhere. For investors, the message is clear. Don't get lost in the short-term noise about interest margins. Focus instead on the bigger picture: user growth, product expansion, and the potential for a more active, risk-on environment. If those trends play out, Robinhood could be one of the biggest beneficiaries of the Fed's next move. So as we head into the new week, keep your eyes on crypto, watch the Fed, and remember that Robinhood is no longer just reacting to the market. It's actively shaping the future of how retail investors engage with finance. That's a story that doesn't depend on whether rates are 5% or 3%. It depends on Robinhood's ability to innovate, execute, and capture the next generation of investors.